Now that we have seen the definition of current assets and current liabilities, let us see what are the items which are categorized as current assets and current liabilities. Firstly, talking about current assets, the first item we can say is inventory. Inventory can be in the form of raw material, work in progress, as well as finished goods, finished stock. Therefore, all these three will be categorized as inventory under the head of current assets. Then receivables, that is bills receivables or debtors, trade receivables. Then we can also have cash and cash equivalents. What are cash equivalents? Cash equivalents are those items which are equivalent to cash but not cash. You have bank, you have cash in bank, you might have cash also in marketable securities. So why are we calling it as cash equivalents? Even if you have cash in your hand or cash at bank, it is as good as having cash in your hand. You can immediately withdraw the amount. Today you have ATM facility wherein instantly you can get the money, not even by going to the bank also, even on a bank holiday you can get the money from ATM. Also, in the name of short-term securities whose maturity is less than 2 days or 3 days, even they are considered as cash equivalents. That is, within 2 to 3 days you can sell off your securities and get cash. Therefore, cash and cash equivalents are categorized under one head. And lastly, prepaid expenses. Therefore, these are the major current assets which we will be talking in this chapter. Moving on to current liabilities. Payables, that is trade payables and bills payables, and then outstanding payments, that is in the form of wages or salaries. These two will be seen majorly as current liabilities. Friends, the concept of working capital can be understood in two angles. The first angle is on the basis of value and the second is on the basis of time. Let's go one by one. On the basis of value, working capital is defined as gross working capital or net working capital. Now, what is gross working capital? Gross working capital signifies the investment of working capital in current assets. That is, whatever is the investment made in current assets itself is called gross working capital. Hence, ideally speaking, working capital refers only to the current assets, but current liabilities will support in reduction of working capital to some extent. Hence, we will consider current liabilities also and then reduce the requirement of working capital, which is now called as net working capital. Therefore, on the basis of value, if it is complete investment in current assets, it is called gross working capital. If it is current assets minus current liabilities, such reduced value of working capital is called net working capital. So, this is about working capital on the basis of value. Coming to the basis of time, working capital on the basis of time can be categorized as permanent working capital and temporary working capital. Now, what is permanent working capital? As the name suggests or as the name says, permanent working capital is that working capital which is required permanently by the company throughout the life of the company as long as it operates. Now, can we in simple words say it is the minimum working capital required by the company? Absolutely yes. So, irrespective of the conditions happening outside, be it in the market, be it due to demand and supply, be it due to the increase in or decrease in productivity of the production levels of the company, whatever be the reasons, what is generally the minimum working capital required by the company based on its nature of industry, based on its policies, based on its practices? Such minimum level of working capital required by the company throughout is called as permanent working capital. Now, over and above this working capital, if at all additionally there is a need of some more working capital, such working capital is called temporary working capital. We can say it is something like a situational requirement based on time, friends. At any point of time you require same amount, that is called permanent working capital, but situationally based on time or based on the demand and supply, based on various any other factors, if there is a requirement of additional working capital over and above the permanent working capital, such working capital is called as temporary working capital. Now, if you observe in a graphical format, for a stable company, permanent working capital will be a straight line, a flat horizontal line. Now, whatever are the lines, curved lines seen over and above the straight line indicate the temporary working capital. Now, in the case of a growing company, even for a growing company also, the permanent working capital will be straight line only. Only point is, as the company is growing, there will be an increase in the permanent working capital. Therefore, you will see an inclined straight line instead of a horizontal straight line. Now, over and above this permanent working capital, inclined straight line also, whatever is the working capital required based on the requirement, based on the situation, such excess of working capital over and above the permanent working capital is called as temporary working capital. Friends, let us now talk about the significance of working capital or the importance of having adequate working capital. We already mentioned earlier that a company generally invests most of the long-term funds in the long-term assets and keeps aside a component of this for the purpose of utilizing for working capital. Now, how much has to be kept aside and how much has to be invested depends upon the nature of the company or the nature of the business, then the production policies, the policies adopted by the company, the demand supply and the market conditions, so many other factors. But end of the day, the company has to know how much it has to keep aside or invest in working capital. The first question comes, when we say we are supposed to keep adequate, immediately what do we say? What happens if we don't keep adequate working capital? So only when you know the effects or results of not doing something right, you will be careful in doing what is right. Now, coming to the point, what happens if we do not maintain adequate working capital? Now, not maintaining adequate working capital means there can be two scenarios. One, having too much of investment made in working capital, or two, having too less investment made in working capital. Let us talk about the first case. If we invest too much in working capital, it is a scenario which is similar to overcapitalization, which leads to unnecessary idle funds. So friends, what is the meaning of idle funds? The funds are kept idle in the name of working capital. You have brought them and dumped here and they are being blocked. They are not utilized effectively, not just theoretically, friends, practically also. If you see, any fund involves some cost. Therefore, these idle funds will also involve idle cost. By blocking too much of huge idle funds, you will end up in paying huge costs for unnecessarily for the purpose of simply blocking these funds here. Therefore, because of this, even though the liquidity will be seen to be more, the profitability will fall down. On the other side of the coin, what if we maintain too less working capital? You may say, now profitability will be more, we are avoiding idle costs. But friends, by not having sufficient working capital, it leads to lack of liquidity. That is, it may bring up or trigger a situation called insolvency. Not having sufficient current assets to address the current liabilities will not only lead to illiquidity, will also lead to a threat to the company. The current liability providers, that is the loan providers for the short term purpose, they will have a threat whether these liabilities will be addressed or not. Therefore, there has to be an adequate working capital. What is working capital? We said current assets minus current liabilities. Therefore, current assets should always be more than current liabilities to address comfortably and sufficiently. But at the same time, it should not be too high also to result in unnecessary costs. Therefore, in simple words, can't we say the entire theme or game of this chapter is to understand the interrelationship between current assets and current liabilities? Absolutely, yes. Therefore, the main agenda of this chapter is to know as to how much has to be invested in working capital. Therefore, friends, maintenance of adequate working capital is not just a short-term need. It also plays a vital role in the long run of the business. Therefore, whenever a company wants to make an investment decision, it should not only think about the building, the plant and machinery, that is all the fixed assets. It should also consider the requirement of additional current assets for the purpose of running of the business. That is, say for example, the company's productions have increased, the production levels have increased. Obviously, what happens? The inventory levels will increase, that is the current assets will increase. Similarly, if the sales have increased compared to the past, definitely there will be an increase in credit sales there, that is debtors will increase. Therefore, in the same lines, whenever there is an increase in the operation of the company in a larger scale, definitely there will be an increase in the requirement of working capital also. Hence, the question comes as to what is the optimum working capital? What should be the ideal or optimum working capital to say it is an adequate working capital? Friends, if you remember, if we go back to the chapter called ratio analysis, there we have mentioned that in general, especially for manufacturing concerns, the adequate or reasonable ratio of current assets and current liabilities is 2:1. Therefore, generally for manufacturing concerns, we can say 2:1 is considered as optimum or optimal for manufacturing concerns. When you say current assets by current liabilities, when you talk about current ratio, the current assets should be at least twice the current liabilities to address these current liabilities and to have a proper liquidity position and not to have too much of unnecessary blockage in working capital. Similarly, you can also talk about the asset test ratio, that is quick assets by current liabilities. What are quick assets? Is that we will remove stock and prepaid expenses from the list of current assets to call them as quick assets. Therefore, these quick assets, the assets which can be quickly realized, the assets which can be quickly realized, that is within a span of 3 to 4 months, should be at least as much as equal to the current liabilities. Therefore, with the help of these two ratios, we can say these can be considered as optimal ratios. But friends, please trust me, having exactly 2:1 does not indicate it is the optimum. There may be companies or there may be industries wherein even 2:1 is not required. For example, if you take restaurant business, there is a requirement of working capital. Today you purchase the raw material, by end of the day you generate sales. See, it happens so rapidly, there is no time lapse at all. Therefore, it all depends upon the nature of the business as to what has to be the optimum current ratio or asset test ratio.